Well, hi, everyone, and welcome to the Buffett and Beyond Saturday Market Recap Letter. And this is June 3rd, 2023. And these methodologies are based on the book Buffett and Beyond, second edition. And remember, folks, if you want to live on this beautiful beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And this week, well, once Congress got their act together and passed the debt ceiling bill, which the president said he would sign, the market took off like a rocket, and the semiconductor stocks took a breather while the rest of the market played catch-up. A very nice end to a wonderful week. In our weekly stock analysis video, well, we have new numbers on Apple. And folks, if you think about it, all we have to know about Apple is that we cannot do without our iPhones. And guess what? Apple makes them for us. It's as simple as that. In our ETF video, well, the top 5 stocks in the semiconductor ETF are up over 64%, and the top 5 tech stocks are up 41%. We look at the healthcare ETF, which looks to be starting a rally in order to make up for lost time, but it looks like the semiconductor and the tech stocks are going to take a breather in here because they've moved so far so fast, and there's something called the reversion to the mean. And we're going to see what reversion to the mean is all about. And here we are. This is the S&P 500, and you can see that we were doing nothing around this 4,200 level all the way back over here to the left of the chart, which we cannot even see. And then all of a sudden on Thursday, it lifted up to the top of that band, and Friday it just took off all the way up above the top of this band, which means it's a very, very strong market, because 95% of the time the market stays within this top band and the bottom band. And these are volatility bands, and these specific bands are called Bollinger Bands because they are 2 standard deviations above and 2 standard deviations below this center line, which is a 20-day moving average. Bottom line, it's all contained within these 2 bands, and when you go outside that band, you have to watch out. In this case, we're watching with a big smile on our face because it's above the top band. Very, very nice. And look down here, our intermediate term indicator is pointed up. We finally got that break where right in here it was all braided. It was close. It didn't know what it wanted to do. Finally broke up, and the big stocks pretty much took a breather, so the rest of the market is catching up, and that's a good sign. And let's look at the QQQs. Now, the QQQs represent the NASDAQ 100 stocks minus any financial stocks. And we can see it has just been pushing this top band all the way up. And when we come down here, yeah, this has been in a buy situation for a long time now, for just almost a month. And it's doing very, very well. And, of course, that's where the tech stocks are, and that's where most of the semiconductor stocks are. And when we look at the S&P 500 again, the green line is the 20-day moving average. The blue line is the 50-day moving average. And you can see that we are far above both the 20-day and the 50-day moving average. And what I talked about before was we expect a reversion to the mean. So the market will slow down for a while and maybe go sideways, maybe drop down a little bit and fill in this little gap. And the 20-day moving average, green line, and the 50-day moving average will catch up to it. So the reversion to the mean always happens, like right in here. It got ahead of itself too much and then came back down to the 20-day moving average and stayed there almost a month and jumped up, jumped down, and now it just took off to the upside. Very, very nice move. And down here, of course, we can see that intermediate term indicator turning up. A nice move. And portfolio protection, well, this is for about $135,000 portfolio, and we have 3 SPY, those are the SPYs, represent the S&P 500. We have 3 of those puts in place. Now, with the intermediate term indicator pointing up, we'll give it another day or two. Some of you will be taking these puts off, or you can write puts, sell other puts. You see these puts here? We bought those puts for the portfolio protection. But now that the market is giving us a buy signal, then we can sell some puts right under the 410, say in June or July. Not all of them, but we'll do a little bit at a time, and we will recoup just about all the money that we spent on these puts as we go along. And also in our daily letter, you'll notice that we had some really nice trades this week. And the reason we trade is because we want to be able to earn enough money to buy these puts and earn enough money. The portfolio managers who use our system will try and earn enough money to pay for the fees for their clients for the entire year. That's what the daily letter is all about. So yeah, we had a good week this week. We made some money on the upside. We made a lot of money on the upside, and we can take some of that money and pay for these puts. And as we go along, we'll be selling some of the puts below the 410 level here to make up for these puts, or the cost of the puts, I should say. So, folks, if you want to live on this beach like Jimmy Buffett and watch the sunrise through this little hole in this seashell here, if you want to live on this beach like Jimmy Buffett, all you got to do is learn how to invest even better than Warren Buffett. So, folks, our portfolios have outperformed Warren. Warren has outperformed the S&P 500. It's a good day all around. Folks, go out, enjoy the weekend, be with your loved ones, and we'll see you back here on Monday.